The VIX question is fascinating because, I mean, some have even tried to argue that somehow the VIX is broken, given high correlation between sector, and this sort of acts as a suppressant on volatility.
No, I don't think the VIX is broken. You know, the VIX went from 10 last year to 36 in December, and it's now at 15. So that's about a 60% retracement. But the S&P went from 2940 to 2347 to 2770. That's about a 72% retracement. So the VIX is always the mirror image of the stock market. It spikes when the market, kind of panics, and it sits around doing nothing when things are quiet, and things are relatively quiet today, and that's why the VIX is just sitting here at around 15. But it's certainly not the lowest level we've ever seen. 10, even 9 are numbers that we've seen. So I think it's okay here.
Ernesto, the flip side of this all is that, after the outflows that we've seen in the wake of the December sell-off, there's a lot of cash on the sidelines, and the VIX actually may enable investors to take part of this rally, even if they're skeptical of this rally. Because the VIX is so low, they can actually protect their positions.
Well, yeah, I mean, there is a great entry point in the market here. There was a better one in December. What you have to get rid of all the noise that you hear and just focus on the most important things, which is earnings growth. And you see the market still, by the consensus of analysts out there, is looking to gain about 10 to 12% in terms of earnings growth this year relative to last year. And the valuation is fairly attractive, especially in the value sector, at about 14 times relative to the growth sector at 20. But overall, the market's trading at about 15 to 16 times with this kind of earnings growth of 10 to 12%. This is a good market. The earnings recession that everybody's talking about has not yet materialized in the numbers that the analysts are putting forth. And so get rid of all the noise, don't be distracted, and focus on the fundamentals, and you'll be okay. It's a good market to put your money to work in.
Hey, Jurrien, what happens to volatility if we get some China resolution in any form? Does it spike because people then start having to discount the impact on various sectors from a resolution?
No, I don't think so. I mean, if we get a trade, deal, I mean, my expectations continue to be fairly low because I think this is a very long game, and even if there's a win here, who knows what's going to come around the corner, in a week from now. So I continue to have fairly low expectations, and some resolution is, I think, already priced in. So if anything, there may be a sell the news kind of occurrence if there is some sort of announcement. But again, volatility is inverse to stock prices. So if stock prices go up because there's a resolution, then volatility is not going to spike. If somehow the market trades off because there's no deal, then the VIX will probably come up here. But to Ernesto's point, this is really all about the earnings and expectations. The estimates from analysts for this year were at about 12% in terms of expected growth 3 months ago. They're down to 5.3%. So expectations have come way down. But the 2020 number is still pretty high at 11, and that is fairly normal because those numbers always are way too high when you're out in front of by a year or so. So the degree to which earnings rebound in the second half and then sustain themselves in 2020 really will tell us most of what we need to know about the Fed, about valuations, and about where the market's going and where the VIX is going.
Ernesto, I want to key in on what Jurrien said, and David and I were just talking about this, so whether or not a deal would be a sell the news sort of event. If that is the case, would we see the selling hardest in sectors like Chinese stocks? I mean, the CSI 300 is up, 15% year to date. It's the best performing market around the world. Will we see that sell off hardest in the sectors in the stock markets that have gained the most this year?
You probably will, and again, don't focus on the short term. Focus on the longer term is what we want to do. At BMO Global Asset Management, we're looking at indicators of market action and stock valuation going out 12 to 24 months because the short term is almost impossible to predict. You have so many things going on. There's a potential disruption from whatever the Mueller report, which is due to come out within the next month, might do, and how the president might react, and what distractions or actions he might take to distract the attention from the Mueller report. So all of that just creates a lot of noise that you don't want to focus on. You want to focus on the fundamentals, and the fundamentals so far seem good. The short term is always impossible to really get right, and it's better just to keep focused on the fundamentals in the longer term, in our opinion.